All right, that is the closing bell down on Wall Street and at the NASDAQ market site. Welcome to Market Domination Overtime, giving you full coverage of all the moves to get you up to speed on the action from today's trading. Stocks closing lower to finish the trading day, retreating from those records. For more on the moves in today's market, the overall setup, let's bring in Michael Green. He is the Chief Strategist at Simplify Asset Management. Michael, thanks so much for stopping by. So let's just start with kind of your take on what role the Fed has played over the last month. You know, I think it's exactly a month today from when Powell spoke at Jackson Hole. Knew the rate cut was coming. We got the guidance last week. We've seen markets levitating, pretty orderly up to those record levels. What you've made of that action and how you're thinking about the Fed's role at this point in today's action, in the cycle, let's say.
Yeah, I mean, ultimately, I think what has transpired is with the introduction of and confirmation of the rate cuts, we saw the bond market rally slightly. They've come off of the best levels, but that ultimately creates collateral, right? Mm-hmm. And so what is actually happening is if your bond portfolio is performing, you're running a systematically rebalanced portfolio like a target date fund, which most Americans are invested in their work retirement funds. That will actually ultimately, an increase in the bond market will create additional ammunition for buying stocks. That helps stocks rise. It has nothing to do with economic outlook or anything else. It's really just a mechanical property of the system. What we've really seen over the last month has been rising retail participation, particularly in meme stocks, unprofitable tech stocks, et cetera. There's very much the same energy that we saw emerge in the post-COVID environment, in which people are simply saying, hey, I want to get in. Right, I want to be part of this.
So when you see that, like, what does it say to you about maybe those names, but also just like, does it make you nervous, or is it just something like, oh, I guess we're doing this again?
Well, there's an element of, I guess we're doing this again, but I think the much bigger component that it's ultimately highlighting is how, what I use the term inelastic, how inelastic the market has become. For relatively small sums of capital, we're seeing extraordinary price moves. Oracle, of course, is one that's caught many people's attention. We've seen this across many other market capitalization names, the circular phenomenon that we're now seeing with NVIDIA and Oracle and AI and the related names. This is simply powering a market to move on very, very low volumes. At the core of it sits the underlying dynamic that over 50% of the market capitalization is now effectively hodled inside passive vehicles. Mm-hmm. So when those flows come in, it's the equivalent of trying to buy a low float stock, and it causes prices to rise anomalously in a way that you wouldn't expect a mega cap to respond.
And so we see that dynamic in the public markets where more of the capital, more of the dollars are put into index products, which are, they're not responsive to price in the same way. What role, if any, as you think about it, do private markets play in that? Because private markets are now taking a lot more capital out of the system, and that obviously, some of that is coming from public markets. Does that even further, let's just say, like, cut the float, if that's really what we're talking about, of assets that are available in public markets that could get that more active mark?
Well, I'm not entirely sure I follow your logic, but I would.
Okay, so if I would have in the past, I have a $10 billion fund, I would have $10 billion in the stock market. Now I can basically get large cap tech exposure, but I can buy OpenAI, I can buy Stripe. I have all these other avenues to allocate dollars. Therefore, if there's less active price discovery within the stock market, it's creating these dynamics that we're talking about around fewer dollars creating larger moves even in some of the biggest companies.
Yeah, so I actually would emphasize not so much as the fewer dollars, because the funds that you're describing, largely institutional funds, have been diversified for an extended period of time. What's different this time around is ultimately that their private investments aren't returning capital to them at a pace that allows them to continue to re-up those investments. This is one of the reasons that you're seeing the private equity or private credit space begin to actively try to seek entry into 401ks, because they are trying to tap into that capital that in many ways they're currently restricted and barred from participating in. Yep. The feedback loop is significant, though, because ultimately, particularly in the credit markets and in private equity, this is also somewhat true. You have a component of valuing yourself against publicly traded peers. So if we look at the valuation of OpenAI, for example, we're going to immediately point to the valuation of a Microsoft or an NVIDIA or others and say, well, if those are valued at this, then this much more rapidly growing entity should theoretically be valued even more richly. That in turn is creating collateral similar to what we described in the treasury market or in the bond market that is supporting even more valuations. Increasingly what you're seeing is investments that are being made into entities like an OpenAI or others that is then being used in a vendor financing role to purchase NVIDIA semiconductors. That in turn is they're then back end guaranteeing it. This means we're introducing things like variable interest entities and financing arrangements, contingent liabilities that are really changing the profile of investing in many of these stocks. But people are not yet at a point where they're willing to change their behaviors tied to that. And I think it's going to be very tough to get them to get there.
You know, we were just talking to Chris Whalen earlier about some of these non-bank lenders that are bigger players in the market now. And it feels like you're kind of also pointing in that same direction of just these different pools of capital that, the structure of the market has really moved away, maybe a way to say it, from places that people can easily see it. Does that feel right to you?
I think that's true. I think the key point that I would emphasize is we have driven consolidation in Chris's sector and the banking sector. It becomes harder and harder for an entity like a JP Morgan to evaluate the local pizza shop for credit applications. It simply doesn't move the needle in the same way. And so they are incentivized to outsource that credit creation function to what are called non-depository financial institutions, basically the buy now, pay later lenders, or many of the private credit entities. From the bank's perspective, they're taking a very low risk, right? They're lending to a large entity that theoretically has significant equity value and theoretically has significant credit expertise. As a result, they're able to hold lower reserves than if they were to actually make that loan to Joe's Pizzeria.
I see. And then lastly, I want to talk, speaking of, kind of structure, new products, things like, now you can trade options for free, but then you've got zero-dated options and all these different products we've seen come into the market. How do you think about the role that those can play in this daily price discovery, where you just get a lot of action around, big round numbers all of a sudden? I mean, they've always been influential markets, but now you have more retail money looking at these, again, daily options. It just feels to me like this area, and I've talked about this with a few folks, like, we know it's changing things. We're not totally sure how, but are you seeing signs that we're beginning to get the impacts of that access for more people?
So we definitely see that. I would just emphasize that there are some innovations that are actually quite good, and there's some innovations that are less helpful. I would actually argue that in many ways, zero data expiry options enhance a function we call market completeness. It's important that I understand whether volatility is priced for today or tomorrow or the day after. We couldn't do that prior to the zero data expiry options. There's a second feature, though, of zero data expiry options, which is effectively they're like the come line in a craps game, right? If you're above it, you make money. If you're below it, you lose money. And that's a very appealing gambling instrument. What we've seen in the retail world is adoption of these strategies that is scaled somewhat exponentially. In other words, they're losing significantly more money on options than they used to. It's just happening faster, and so it feels more like a game that they can play repeatedly. Many people are going to be anecdotally very successful in this. Certainly that's celebrated in chat rooms and Discord servers, et cetera. That creates feedback loops where other people say, why not me? The simple answer is that there is a significant premium associated with volatility trading. Most people that are involved in volatility are interested in selling volatility. There's a premium that's priced for that implied volatility relative to the realized, because you're selling insurance policies. That tends to be the province of people who have studied this stuff for a very long time. I'd suggest that people are becoming increasingly cavalier in their comfort level in taking on those types of risks.
All right, great conversation. We'll leave it there. Michael Green with Simplify Asset Management. Thanks so much.
Thank you.
All right, Micron out with its fourth quarter results on Tuesday, topping Wall Street's expectations across the board and providing an upbeat outlook. The company reporting adjusted earnings per share of $3.03. That's ahead of forecasts for $2.84. Revenue coming in at $11.32 billion in its latest quarter. That is ahead of the 11.15 that Wall Street was expecting. Stock here up about 3% in immediate reaction to the numbers. And joining us now to discuss the quarter is Daniel Morgan. He's a VP and Senior Portfolio Manager at Synovus. So Daniel, I'm curious, your initial reactions to the quarter that we just got from Micron.
Well, it looks like a strong quarter across the board here. We know that Micron came out about a month ago and guided for this upcoming fourth quarter, and they actually beat that, as you announced the numbers, $11.31 billion in revenues on the fourth quarter, then $3.03 in EPS. But the big positive is the guidance they gave for this upcoming first quarter of 26. The street was looking for $11.7 billion. They came in at a midpoint of $12.5 billion, I believe. And also their EPS guide, $3.60 to $3.90 a share, midpoint $3.75. Street was looking for $2.98. So if we look at this report, it looks very, very good. Beat on all metrics. Of course, we'll get a little more info on the conference call, but it appears that the AI trade is working really well right now for Micron.
Yeah, and I'm curious, Daniel, when you look at Micron and where the company is in its own life cycle relative to the AI trade, where it fits in right now. I mean, you can kind of pick a day of the week. You figure there's going to be an NVIDIA headline. Kind of feels like they take a lot of air out of the room when it comes to the chip side of the equation. But where is Micron right now, both on its product development side and sort of how it's being seen within this AI arms race?
Well, you're right. So let's take a step back and just make sure everybody understands the difference, right? NVIDIA produces GPU chips that go into the servers that run these big AI data centers. If we look at a company like Micron, they're producing something called high bandwidth memory, or DRAM. They're producing the RAM, or the memory that allows this chip to run. So their biggest area of growth is called HBM, high bandwidth memory. Right now they're producing level 3. They have level 4 coming out next year. So these chips are being paired up with, let's say, NVIDIA's Blackwell, also with their Rubin chip. They're also getting some benefit from producing memory chips for the new ChatGPT 5, which is going to be coming out from OpenAI. So we have to look at them not as a direct producer of AI chips that would compete against an NVIDIA, but a company that builds a complementary chip, a memory chip that runs with the NVIDIA GPU. So they're benefiting from what NVIDIA is doing.
And I think when you look at the Micron story, or just when I look at the stock, it's had a little more volatility, it seems. And it sounds to me the way that you're describing the story is it's to an extent out of their hands. They're somewhat following on the coattails of what others are doing. But just what does that company, like, where does that fit in if an investor is trying to think about playing the AI trade? How derivative down from I make the AI tool or I provide the key chip, how far down that stack is a Micron in that kind of conversation?
Well, you have to bear in mind that their core areas that they produce are NAND, with chips, flash memory chips that go into cell phones, and DRAM chips, which go into data servers, laptops, and PCs. Typically, a cycle, Myles, will last about 6 to 8 quarters, where you have an uptick, because it's very cyclical, 6 to 8 quarters, and then all of a sudden you get a big downturn in demand. We had a big uptick for DRAM chips during the work from home effort during COVID, because everybody bought a laptop and a PC and worked from home. That put a lot of upward pressure in terms of pricing on DRAM chips. So we are now going to have, this would be the 6th consecutive quarter of profit growth coming out of them. But I would argue that because of AI, we're going to see that typical cycle be extended beyond 6 to 8 quarters. So I think at this point it is a trickle-down stock. It's a trickle-down stock in regards to NVIDIA. Mm-hmm. Otherwise, demand is solely based on iPhones and mobile phones and demand for PCs and laptops. And those are pretty mature product areas.
And last one. Is this the beginning or is this the end of the earnings period for these chips companies? I can't make sense of whether are we capping something or am I thinking forward here?
Yeah, we can pop the champagne off. Micron is the last company report. Now we're going to pick back up with the third quarter in October. The first big print will come out of IBM, I believe, on the 22nd. Then Intel comes in, and then all of the big hyperscalers start coming in with Apple in the tail end of the October, beginning of November. So yes, you can cap off and say, hey, we're finally done with tech, at least for a couple of weeks.
There you go. $200 billion market cap, you're allowed to end the proceedings there. All right, Daniel Morgan with Cinevis. Always appreciate the time. Thanks so much.
Thank you.
We talk a lot about the Fed's dual mandate, jobs and prices, but did you know that there is a third? Newly appointed Fed Governor Stephen Micron just raised it on the Hill a few weeks ago. And on today's Stocks in Translation, we're going to break down the Fed's 3 mandates and why they matter for your money. In the 1970s, Congress tasked the Fed with 3 goals. The first 2 are commonly known: maximum employment and stable prices, which the Fed interprets to mean 2% annual inflation. The third is rarely discussed, though. It's moderate long-term interest rates, and it refers to the long-term borrowing costs on Uncle Sam's debt. And for years, the Fed simply called it a dual mandate because moderate long-term rates are supposed to flow from good inflation control and strong employment. But that third line is written into law, and it's back in the conversation. Let's review a timeline of how we got these mandates, which are intertwined with Fed independence, the notion that the Federal Reserve should operate without influence from the White House. In the 1940s, the Fed helped keep long-term rates ultra low. After the war ended, there was a lot of pressure to continue, but it finally came to an end in 1951 with the so-called Treasury-Fed Accord. Then in 1965, President Johnson tried to get the Fed to once again lower long-term rates to fund the Vietnam War and his social programs. LBJ invited Fed Chair Bill Martin to his Texas ranch and reportedly threw him against a wall in order to intimidate him, but Martin held fast. Then in 1977, Congress finally codified the three mandates, which we already discussed. And fast forward to just a few weeks ago when Stephen Myron invoked the third mandate as he addressed the U.S. Senate during his confirmation hearing for Fed governor. Shortly after that, the Fed cut rates, as expected, for the first time since December. And Yahoo Finance Fed correspondent Jennifer Schonberger asked Fed Chair Powell about the Fed's third mandate at the presser following the decision.
We always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment.
Translation, the Fed doesn't see a separate knob that it needs to turn for long-term rates. But if those rates get unmoderate, then politics could get loud and fast. So let's take a second and review why long-term rates matter. These affect Americans' borrowing costs for homes, cars, and business. They can affect stock prices as valuations, as well as projects that get funded with borrowed money. And they directly affect Uncle Sam's interest rate bill, which, by the way, tallied $1.2 trillion last year. And remember, when the Fed first started cutting rates in September of 2024, mortgage rates, they jumped for weeks. Long rates do not always follow the Fed. They follow supply, inflation risk, and investor appetites. And this is where the third mandate debate really gets real. If long rates surge, they tighten financial conditions even though the Fed is cutting short-term rates. That can hit housing, tech investment, and as well as the federal budget. All of that at once. So here's what to watch out for next. Listen to rhetoric out of D.C. surrounding the Fed's third mandate from Myron, D.C. insiders, or even President Trump himself. Then watch that court case that will decide whether or not Fed Governor Lisa Cook can be fired by President Trump. If she goes, Trump could stack the Fed with more rate-sympathetic doves. We're also going to watch out for news from the Treasury about borrowing needs, which affects supply. And finally, watch the yield on Uncle Sam's 30-year debt. If it heads north of 5% again, that could ramp up pressure on the Fed as monetary policy gets tighter, even as the Fed cuts rates. Bottom line, the Fed's dual mandate may be doing the work, but the third is back in play. And if long-term rates don't stay moderate, markets and politics could force the conversation. And tune in to more episodes of Stocks in Translation. New episodes drop every Tuesday and Thursdays, which you can find on the Yahoo Finance website or wherever you find your podcast.
All right, time now for what to watch on Wednesday, September 24th. Starting off with the Federal Reserve. We'll get even more commentary from central bank officials on Wednesday. San Francisco Fed President Mary Daly is set to speak. This comes after Jay Powell said weakness in the labor market is outweighing concerns about stubborn inflation, leading to the central bank's decision to lower rates at September's FOMC meeting. Taking a look at the earnings calendar, a few more names reporting on Wednesday. Notables including Cintas, KB Home, and Stitch Fix. KB Home is announcing results for the third quarter after the market closed. The housing market has been sluggish this year with elevated mortgage rates and affordability issues. Investors will be listening closely to the call for any commentary about how a lower rate environment could impact the company as we head towards 2026. And speaking of housing, new home sales data for August is due out on Wednesday morning. Economists are forecasting sales slowed slightly to an annualized rate of 650,000 homes last month.